Awesome. So we're going to kick things off. Thank you guys so much for coming to Angel Summit here with Signal Fire. We really love getting to talk with you. And I'm here with one of my favorite people in all of tech because he has just seen such an incredible breadth of products, and that's given him such an incredible perspective about what's coming next. And so I wanted to thank Ryan Hoover from formerly Product Hunt and now from Weekend Fund for joining us here at Angel Summit. Thanks for coming, buddy.
Cool. Yeah, happy to share that context and kill some time here. So quick background of myself. I started a company called Product Hunt just over 7 years ago, just really based on my interest in technology and products and discovering like the new cool thing. And, that's grown significantly to a really global community of people and founders launching their products to the world. And about 3 or 4 months ago, stepped down as CEO. But before that, I started Weekend Fund to invest in early stage companies. This was shortly after Product Hunt was acquired by AngelList, so about 3.5 years ago. And now we've been investing roughly in about 75 companies to date, investing 100 to 200K check size, everything from consumer to B2B. We're very open-minded. We have a few areas that we're keen on, but we're open-minded really to invest in promising companies, crazy ideas, and yeah, it's been fun. So when I say we, by the way, I should preface that Vedika, she's in London. She works with me on the fund, and she's amazing. So it's just us two on the fund side.
I want to jump right in with some of your best advice for angel investors that are out there in the crowd. So just like for starters, you guys, you've come so far, but what is your favorite piece of advice for your investments? Like, what's your broken record refrain when you're talking to, that could be other investors, but also maybe to your portfolio companies? What do you tell people over and over again?
Yeah, I mean, some of the cliche advice is sometimes true. So I'll try and avoid some of that. I think with investing, I mean, to be honest, I'm learning investing is a weird role where the feedback loops are very, very long compared to like building a company. When you launch a product, you put it in the market, you quickly know within days, weeks, months that it's working or not. In investing, it takes months. Even the paper returns that we have right now aren't, realized. So we'll see how good we actually are. But, with investing, I think one of the most basic yet important things to, I think, realize is there are people and friends that have come to me saying, hey, Ryan, I really want to start investing. I really want to, start writing some checks. I have a little bit of money saved up. And my number one advice is first, you need to invest in enough companies if you're investing at early stage. I think some people think that they can invest in a couple companies a year, and you can, but the odds of it, being successful are probably pretty low. The beauty of investing is that you can only lose 1x your money, but you can gain theoretically 100x, 1000x your money. And, as a result of that, you need some diversification. And so you need to really create more of a portfolio. There's this blog post, and I'm forgetting who wrote it, someone at 500 Startups a long time ago, that starts to model out the essentially the distributions as you start to increase your portfolio size and potential outcomes. And all things being equal, once you hit to, I think it's like 40 or 50 companies in a particular fund, that's when you start to see kind of diminishing returns in an additional company in that fund. Long story short, you have a better chance of making more money the more companies you invest in, up to a certain point, essentially.
Yeah, that's a great piece of advice. I think a lot of people just think, oh, I can jump in, I have some like hot deals and make a few investments, but without that diversification, you're really vulnerable to like huge macroeconomic shifts. Like if you only invested in a few companies in like the events or the travel space, for instance, suddenly your portfolio is tanked. Whereas if you have a bunch of work from home and collaboration startups in that portfolio as well, in 2020, you'd still be doing okay. So I think that diversification is a really important idea. But to get to that, you need to have deal flow. And so maybe you could talk a little bit about what you think of as some maybe repeatable ways that you try to build your deal flow. Obviously, you have some like special opportunities from your connections with AngelList or Product Hunt, but if you had ways that you think that others could probably use as well to start to build that deal flow, so you have the diversification of opportunities, so that you can actually make stringent, like strict, stingy bets and not just invest in the first things that you see. How do you build up that deal flow as an angel?
Yeah, I mean, I think this is also super simple, basic advice, but tell the world, tell your friends that you're investing. So this is more advice for people who are just starting out. I think a lot of people who want to angel invest, the number one thing is first let people know that you are in angel investing. So that can be telling your friends, telling people that that invest, just to let them know what you're interested in, what check size you write, just to be top of mind, ideally. But then two, basic things like update your LinkedIn, update your Twitter bio to say like you're investing. And some of that is like table stakes and very simple, but it's I think very important, because how do people know to forward you deals if they don't know you're investing or what you invest in? And so I think that's an easy first step, I think, for people who want to get into it. A lot of investing is also, it feels very much like a treadmill in a sense. And what I mean by that is, once you start running, and meaning like you're getting inbound deal flow, you're sharing deal flow, which keeps you top of mind, you're being helpful to other investors, it sort of reinforces itself, and therefore you get more deal flow, and there's a sort of this flywheel effect that happens. But it's also something you have to keep running. You have to keep investing, essentially. Once you sort of fall off and stop investing, people will maybe stop forwarding deals to you. So from a deal sharing perspective, I think those are two basic things to, I think, have in mind. But then a lot of it's also thinking about like, what unique access do you have among a particular community? Like a lot of my thinking is around like community building and like tapping into communities. And so some people have unique networks that maybe it's like their college alumni, or Zooglers, for example, is like a whole networking community of Googler, primarily ex-Googlers, I believe. And there's different communities that people have access to and respect in that they can leverage. And I think it's wise to think about, how are you unique and what unique access do you have to find promising companies, and just really thinking about that and investing time into that as well. Another thing that we're starting to see more of in Weekend Fund in particular is, when you start investing more, you also have founders who hopefully are referring deals to you as well. So sometimes the best deal flow is actually from founders that you've backed, because what happens is founders ask other founders, hey, who should I raise from? Who's been really helpful? And if you are really helpful, hopefully you'll see deal flow from your portfolio. And as that grows, there's more and more deal flow as well.
Awesome. Those are great pieces of advice. So talking about, making sure people know what you're investing in and that you are investing. I especially found that talking about a few of the specific verticals where you have expertise can be really powerful, because oftentimes you just say you're an investor. People are like, well, do they care about what I do specifically? And it's like, oh, they're just a generalist. Are they going to have expertise in something specific? Whereas if you talk about like, oh, I'm really interested in the creator economy or workplace collaboration or consumer social, people start to think of you when they like are building something like that, or they hear about something like that. The flywheel is a huge thing that like once you get started, it starts to go faster, but you have to keep up with it. So definitely know that you're in for the long haul. It is a marathon, but also that idea that like, what unique access do you have? People need to think about, do they have some special way of getting access that somebody else isn't going to? Because that's also going to be a great appeal to your LPs one day. And then servicing those deals after you make them is how you're going to convince founders to tell other founders that you're somebody to have in your round. So talking about that and getting closer with founders, what are some of the tactics that you use when you're trying to convince a founder to take your money? Do you talk about your experience? Do you talk more about your previous investments? Do you use specific testimonials? Like, what helps win those deals?
Yeah, so for us, we I guess the benefit that we've had with Product Hunt is a lot of these founders have launched or are very familiar with Product Hunt, and so there's some rapport in a sense. When they meet us and talk to us, they already know me or know of me. And that's helpful, just building, breaking the ice and being a familiar face. I think back of when I raised money for Product Hunt, a lot of the people that I talked to first were people that I admired or knew previously. And so a majority of those investors, essentially, they built a relationship, even if it was just through Twitter, in advance. And so that's helpful. But then a lot of it's also being very specific on like where we help. I'll be upfront with founders and be like, we're not going to help you with engineering. We're not going to help you with like finance. There's certain areas that we have zero interest or expertise in. And so you can find other people for that kind of stuff. Where we like to help is around like product strategy. That's something that in Vedica actually as well. We were both product managers before Product Hunt for myself. And she was at a couple fintech companies before that. And then community building is I would say one of our more unique kind of value adds in terms of like strategy and ideation when we work with founders. Very few investors, I think, have experience building communities at any meaningful scale. And then the other areas around like fundraising, since we are a small investor, we're not leading deals. We're actually incentivized to be collaborative, whether it's in the current round or like a Series A in the future. But ultimately, we try to communicate very specifically like where we help and then how to use us. And in fact, Vedica she took lead on this project. She just wrote a founder manual that we have published online on our website. Weekend.fund is the site. And you can find this founder manual that goes through the areas that we like to help with, where we can help. And hopefully that just gives portfolio companies, but also companies who are going to speak with us in the future, a very clear idea on how we might be able to be supportive.
Yeah, that's great advice here. Having some kind of familiar face, which often can mean having some kind of content effort. Like whether it's, I think a lot of people assume that you have to be some like a special journalist or have some really special perspective. But I think if you are just willing to do deeper research on something that people care about than anybody else has published, or finding one specific piece of the startup like journey and building a guide to how to help with that can be really valuable. We're doing that right now at SignalFire with the startup recruiting guide. We're building this massive guide of resources to help people learn how to recruit. And that's been really powerful because founders say like, oh, if this is what you can give me just through content, like you could probably help me a lot with hiring once we're invested with you guys. I just put the link to that in the chat.
There's two. Yeah, actually, I'll tie it to Li Jian, I think, is doing a talk at 11, I think, coming up here soon. And so she's done two things that you just touched on. One is creating content, but two, also having a very specific focus, which is on like the creator or passion economy. And she's sort of like carved out her own lane and been now known as like the person to go to for that type of thing. And founders who are building that space, they want to talk with people who really get it, who really understand their space, who can be really helpful. So I think she's a really good example of how you can position yourself in this competitive market.
Yeah, if you guys want to hear about from Li Jian, who's an incredible investor in the creator economy from Atelier Ventures, I'm interviewing her here at noon, so please stick around to check that out. Yeah, I also really like the idea of being upfront about what you can and can't help with, because that helps founders think about how to slot you in amongst their other investors. If somebody's really great at helping with recruiting, you might want somebody else who's great with product, or some other things I think are really valuable include like big network connections or sales leads, and then another is like help with follow-on fundraising. Those are some awesome value adds, and like picking one so that you can slot in amongst other funds can be really valuable as well. So looking back, I want to ask a little bit more about you and specifically what you've been working on. So one of the things that I thought you did, which was really cool for getting some proprietary deal flow, was early in the pandemic, you launched something called Fundraise from Home, where you invited founders to shoot you a video, sort of a selfie video, just explaining their idea. And then from there, you guys vetted a bunch of these ideas, did some follow-up interviews, and then took some of those companies in. Tell me a little bit more about how Fundraise from Home went and any learnings for fellow investors about, maybe that's just about investing over remote, which is like how all investing is happening right now, but also like how running a sort of an event series or an event like that helped you with deal flow.
Yeah, so Vedek and I have thought a lot about experiments, and we try, it's kind of based on a product background, we try to think about like experiments that probably aren't going to work, but if they do work, it could be really meaningful. And so Fundraise from Home is one. We've done a few others like Weekend Pitch, Weekend Build, which I can go into later if useful. But the Fundraise from Home experiment was driven by a couple observations. Like one, fundraising is super inefficient for all parties, really. It's not just for the founder, but also for investors. Two, a lot of people, they think that, and often they do, need some sort of warm intro to really get noticed. And usually the ideal warm intro is from an investor who's also investing. That's the highest signal that you can usually get. And three, we also saw like this of course shift towards remote pitching, where everyone now is pitching through Zoom. It's something that Vedek and I have done since the beginning. She's based in London, I'm in LA. But to get to the point of Fundraise from Home, we ultimately, I would say it wasn't successful from like we're going to continue doing this, but we learned a few things. And actually, let me even tell you the audience like how it worked. Essentially, what we did was we used a tool called Video Ask by Typeform to allow founders to pitch through video, basically just like this. And they just answered a couple of simple questions. So instead of typing up this very long multi-hour process like application form, which you do for like YC and other kind of accelerators or programs, we just want to keep it lightweight. We want to get a sense of like, how does this founder or this team communicate about their problem with their solution, and hopefully do it in a more efficient way than a long form application process. And then from there, we got about 500 applicants, 500 videos from different teams around the world. And we tried to narrow that down into the ones that seemed the most promising. And then we scheduled meetings with not just us, but actually a bunch of other early stage investors. So it was like Todd Goldberg, for example, Neve, Brianne Kimmel, a few others. And the idea was like, how do we make this wildly more efficient for both parties? So let's allow this founder to actually pitch multiple investors at once. So they don't have to like schedule 5 different meetings, but they can do one meeting over 20 minutes to kind of break that ice and hopefully get that interest from one or more investors. And two, for investors, we just wanted to create a new proprietary source of deal flow essentially for them, which hopefully is high quality deal flow that leads to investments. And the punchline is we learned that ultimately it resulted in one investment out of the 9 pitches that came through. And you could say that's like mildly successful if you think about the number of pitches a typical investor does that leads to an investment. So it's not terrible, but it didn't feel as high as it could be. And what we also learned was something that we didn't expect. And this is like when you build a product, put it in the market, you learn things you wouldn't expect. The one thing I didn't expect is certain founders actually did not want to pitch multiple investors at once because they worried that they might burn the chance to get a check from one of those investors if the group as a whole felt maybe more down on the investment. And so they worried that there might be more groupthink in that kind of dynamic. So I didn't expect that. And so anyway, it was a good experiment. It was worth doing, but we're not continuing it. But we're using those learnings for some future ideas.
Yeah, I think it's a really fascinating idea about how you decide do you want to lower the bar too much? And that's one question I frequently get. When I was a journalist at TechCrunch for 8 years, it was getting so many pitches all the time. And, having like big social presences and things like that, you end up getting tons of pitches coming in through DMs and stuff all the time. And, at one level, you're like, you want to give respect to all these founders. You want to give them a chance. You never want to miss an opportunity. But at the same time, you have to balance your time because you need to spend it on pitches that are sort of more high likelihood. And sometimes creating programs where it's really easy to pitch might invite people who aren't that high quality or teams that just aren't quite ready for that stage of investment to be pitching. How do you think about that, especially with your experience with product hunt, how many people you're connected to on social, that you've been the sort of face of product experimentation for a decade in Silicon Valley. How do you think about deciding who to take pitches from, who to say like no to before they've even pitched, just to like preserve your own time?
Yeah, we try to do a bit over email asynchronously. And so not every conversation is like an immediate, like, yes, let's go to a meeting, or no, let's not. But sometimes it's, oh, I'd like to learn more. Do you have any data, or do you have a deck, or do you have a demo? And some founders will follow up with like a Loom video, which is great. Just like a short 5-minute, here's the product, here's how it works. And we find that very useful and efficient actually for both parties, because what it does is gives us data to say, oh, this is interesting and it's like in our wheelhouse and we want to continue the conversation, or not. And if it's not, it's actually also good for the founder in many ways. Like founder's time is super valuable. They don't want to spend 30 to 60 minutes on a pitch when it's not going anywhere either. And so we try to do a bit of that over email in the event that we're like, clearly it's like uncertain if it's like a good fit for us or not. And then the other things that we do when we do a meeting, we try to keep it to 30 minutes. It often goes long if we're really interested, transparently, but we try to keep it to 30 minutes because sometimes if you schedule an hour-long meeting and it's obviously not a good fit, in the first 5 minutes, I really don't want to waste either of our time, the founder's time or ours. And so we try to be efficient there, and then also just be efficient with like getting back to the founder as well. So I don't know, it's a hard one though. I wish there were other ways of finding people, especially those who are less connected. But my advice to founders is just like, yes, money might be a criteria for like getting something off the ground, but traction is what investors are really looking for. And traction is a reflection of like customer value and like what users want. So don't focus too much on like investors, focus on the users and customers, and the investors will come after.
That's a good tip, that if you schedule the meetings to be a little bit shorter, it's almost like a sign of respect that you want to run overtime. But if you schedule a meeting for an hour long and it's not really going that well, or even you just feel like you got the information you needed, but you asked to cut it short, it can come across a little bit like, do you not really care about my time? Do you not want to be here? And I think that's a good point. Yeah, I also think that like the Loom asynchronous video or other ways that you can get people to pitch without it being a full meeting until you're really interested or you believe it's going to be valuable, I think is a great piece of advice there as well. So you talked a little bit over the years about, or we talked a little bit earlier about making sure founders want to recommend you to other founders. And that often requires that like value added services. What do you think about how angels and microfunds can offer those kind of services that can compete with bigger platforms and bigger funds? We're seeing some more mature investors playing a little bit more in pre-seed and seed right now, and because of that, sometimes they bring these huge teams of network and operations people that can really assist, and it can be tough for an angel fund or an angel or a microfund to really say like, oh, we're worth the dollars on your cap table, or worth that equity. So what do you think are valuable ways that smaller funds or individual investors or solo managers can offer that great value to people in their portfolio without having a big team?
Yeah. So one of our portfolio founders, Harry Hurst from Pipe, I've known him since his previous company. Really smart guy. He has this formula, if you want to call it that, where it's like check size to helpfulness ratio. So essentially, how helpful is this particular investor relative to their check size. And the check size is really a reflection of dilution. So essentially, how much are you paying, which is, the equity that you're giving up in your company for the help or the value of this particular investor. And so on one side, when you're an angel, you're like a smaller fund. For us, we're writing on average about 150K check size. That's relatively small to, a big fund who's writing $1, $2, $3, maybe $4 million checks into these companies. And so in some ways, we try to be very high in that ratio. We try to be provide a lot of value for the size of the check or the dilution that they're taking on. And that's partly why we also are very explicit about like where we can help with the founder manual, like product, community, fundraising, et cetera. And so I think on one side, there's an advantage of being small in that you can argue that it's worth the dilution for the value that you provide. But I also think it's just really important to think about like what unique asset or skill or background do you have as an investor, and how do you help the company in a way that's very specific to them. And so when we do make an investment, or rather we offer to make an investment, for many of the times we'll actually outline very specifically like where we think we can be helpful. So usually it's within those categories, but then we try to be more specific around, if it's something community building related, we might share something specific about their company or their business and how we can be helpful in that way. I think it's kind of like, it's like when you sign up for a product or a service, like you have value props and you have like things that are very explicit, and there's like even things like SLAs and like guarantees. We try to think more in that way when we're speaking with founders.
That's awesome. So like drilling into whatever your specific expertise is and trying to offer that as a value add rather than just sort of assuming what founders really want, like go with what's unique to you. Have you seen any other interesting approaches to this that like smaller funds or solo managers have done to provide help? Like one great example I know is First Text, which is a pre-seed fund run by Corey Levy. He was originally funded over a DM, and he wanted to like let the founders be able to get their first checks through a text message. So, one interesting thing he did was allow people to like text him a pitch, and he would use that as their first meeting. But I thought what was really fascinating was he knew he didn't have a ton of team members to help people, but he did have a bunch of great founders. And so he built this community. And so it's sort of a peer support community, which is a little bit similar to like things like Y Combinator and others offer a little bit later stage. But to offer that as a pre-seed investor, even though he wasn't writing huge checks, it became extremely valuable compared to that check size. That ratio was really high of value to check size. And I thought that was a great idea. And we've seen a lot of interesting approaches here with like having your own private Slack community or email list or something like that, where people can trade help for things or ask questions. And I've even seen people turn this into content. Lenny Rachitsky from Air Angels, who's speaking later today at Angel Summit, he runs this incredible paid newsletter, but he also runs a paid community. And what he does is he has an intern look through the threads of his Slack channel, find the most interesting threads, and then he turns that into another email that he sends to his subscribers. So a way to sort of mine value out of that community. So it's not just really synchronous and only for the people in the community. You can sort of share it beyond those walls. I thought that was a really great approach. Have you seen any other really interesting approaches for solo managers or small funds to be able to provide value?
Yeah, I think there's going to be a lot more experimentation in this general space. I think the holy grail is really building something that can scale beyond your own time and your own expertise. Something that we do, I would say it's very lightweight. We thought a lot about creating a Slack group and creating community around the fund. But I also, as a founder who's been invited to many like VC firm Slack groups or things like that, I'm like, I don't need another one. As a founder, you're super busy. And so our version of that is actually we do these founder brainstorms. And so we invite the entire portfolio and say, hey, if anybody wants to meet up, we'll do a video chat for 1 hour, and it'll be up to 4 founders max. And the idea is it's kind of like a combination of peer support, but also a way to like get outside your own head. And since Vedika and myself don't have all the answers, we try to like leverage the portfolio founders as well. And so people come in there. We had a couple sessions last week actually, and they just come in and it's a private, confidential area for them to talk about, hey, I'm having trouble hiring this particular role. What strategies do you all have, to hire, senior engineers? Or, hey, my open rates are looking pretty poor in our like email campaigns. Do you have any ideas? Like we're seeing these things, like what strategies have you deployed or used? Or like, I'm struggling to fundraise, like, here's my deck, can you give me feedback? So what's been nice about that is it allows us to scale ourselves a little bit in the sense that we can tap into the expertise of the network of the community, the Weekend Fund portfolio founders. And then it builds some lightweight community without like the overwhelming like distraction that is, group chats. And so To your point, though, I think we'll see a lot more experimentation. We have some new things we'll be rolling out this year, kind of in that vein as well.
So you moved from the Bay Area to Los Angeles, and that was before this big sort of Texas, Austin, Miami hubbub. But maybe you could just tell us, like, how do you think that's affected your ability to do angel investing? Obviously, maybe that's a little bit different now because of the COVID, and you would have been stuck inside and doing it over Zoom no matter what. But maybe especially before that, before we all went into work from home and quarantine, how do you think it was affecting you, and what advice would you give to investors, especially like early fund managers considering leaving the Bay Area?
Yeah, I mean, it's going to be interesting. So I left about 1.5 years ago before COVID, and prior to that, I was in the Bay Area for about a decade. And on one side, I moved to the Bay Area in 2010 and learned a ton, met a lot of great people. I actually don't think Product Hunt would exist if I wasn't in the Bay Area, because I think I learned and built so many relationships through osmosis in many ways. But I think that is shifting and changing when more people are now, well, everybody's working from home. But also you have these big companies who are now going fully distributed permanently. After the lockdowns and everything are done, they're going to be fully distributed, and therefore more of their team will be distributed across the world, across the country at least. And what's made the Bay Area so powerful is really this flywheel effect that's from universities and from big companies. So let's use a big company example. Facebook, Google, they all recruit talent to come to the Bay Area. They learn, they build a bunch of things, they build relationships, and then they eventually leave and they start a company. Who do they hire? They hire the people around them, the people that they worked with. And so you see all these companies, early stage companies, emerging and starting in the Bay Area for that reason. But as soon as more of these companies are distributed across the country and people work from home, that flywheel is not going to be as efficient. And so I think Bay Area will be important, for the next decade still, but I don't think it will be the same in the sense that it will be like the Mecca in a sense. I think it's increasingly going to be distributed across the country and across the world. And anyway, I think that's a good thing. Now for investors, so prior to the lockdown, I think we only met maybe like 2 founders in person. When we pitched, we always did video calls, and I just prefer it, frankly. I think it's more efficient for both parties. I feel like I can get to know people just as well over video. I frankly don't understand people who are like, I have to meet them in person to really like do my diligence. I'm like, do you? Like, really? I don't understand. So anyway, that doesn't compute for me. We're going to continue, working this way. It's just more efficient. It's also leading deals to theoretically move faster. And so a founder, instead of having to go to Sand Hill Road and I remember when I used to have to travel, I would wish that they would coordinate, like Andreessen Horowitz and like some other big firm would coordinate on the same day, but they wouldn't. And so I'd have to go on Tuesday and then have to go back on Wednesday. And that commuting time, in that amount of time, I could have pitched 2 other investors. And so I think as a result of this, you're seeing more efficiency in pitching, and then therefore, deal flow and deals being done, and combine that with more investors in the ecosystem. Venture is just moving so quick.
Definitely. Yeah, I think that's a great point that when those tech giants move elsewhere, when people spin off of those companies to start their own company, they're going to hire from those companies they were just at, and you can start to get that flywheel happening elsewhere. So final question here in our session at Angel Summit, I want to ask, you've talked a little bit about happiness, and that sometimes people assume that becoming an investor, being a VC, being a successful founder or something is going to bring them happiness. What do you think is really bringing people happiness, and how should people think about that if that's why they're going into VC or investing?
The $1 billion question. It's a question I've asked myself more and more in the past year, roughly. And there's some things I've learned about myself. I think ultimately it's a lot of introspection, and I think the key, in my opinion, I don't know, I'm not that experienced in this world, I feel like, relatively speaking, but in my opinion, the thing is to figure out what am I actually excited about? What gives me energy? What takes my energy? And what you do see every now and then is these certain careers, whether it's investing or being a founder, they're super hot, they're super sexy. Everybody, theoretically wants to be them. But then I don't think a lot of people take a pause for a minute and think what does it actually look like? What does the role mean? And what do I do? And is that, give me energy, or does it take away my energy? So for me, interestingly enough, I'm an introvert, and I get exhausted by back to back meetings. And so parts of investing is actually not that energizing for me. And so while I do enjoy it as a whole, there's things that Vedek and her and I are very similar in many ways. We're experimenting with other ways that are more like products, and how do we build more systems and products that give us energy, building things, creating things is really what's most fun. And I actually think that's also where you can create the most value in venture versus the traditional, like, everybody meets founders, everybody listens to pitches, they do deals and so on, and just rinse and repeat. I think there's more creative and fun ways to approach venture. So anyway, I don't know the answer to that exactly, but those are the things that have been top of mind for me.
Awesome. Well, thank you so much for that. We're really excited to have you guys stay here with us for the rest of the day at Angel Summit. There's a bunch of awesome other sessions starting right now. And then at noon, I'll be back and interviewing Zach Coelius, Wei Jin, and Jeff Morris Jr. to talk a little bit more about strategies for being an early stage fund. Thank you guys so much for joining. And thank you, Ryan, for your incredible advice. And also just thank you for helping jumpstart what I thought of as like the product experimentation age of the 2010s in Silicon Valley. I think that was really important to the culture we have now, where everyone's at home tinkering on new products because they feel like there's a place to present them in the world through Product Hunt. So thank you for that. And thank you for joining us today.
Take care.